we divide the year into 4 quarters, and each quarter has 3 months. So we have January to March, April to June. So this is the end of the second quarter. We have July to September, October to December. Usually in the first quarter, the market is usually rough, especially February. In the second quarter is smooth, going to until August. August is usually rough also. But then the market smoothen to November, and December is usually good compared to November, compared to February. Although people say that they stay out of the market in December, but it's usually good. Now, we usually have trap moves, and trap moves are used by the dealer to trap liquidity before the market shifts for a swing. And these trap moves can be done at the beginning of the day, at the end of the day, at the beginning of a session, at the end of a session. At the beginning of the week, we usually have Monday false move, which is a trap move. And usually we have at the end of the week a trap move there. But also we have during seasonal changes. So during seasonal changes, you can clearly see that the market might go into accumulation, or you can have extended stop hunt, like prices extending further up or further down. And the dealer does that in order to grab liquidity, either internal liquidity or external liquidity, and you shift the market. So let's now go deep into the seasonal moves. So in order for the market makers to make a move throughout the year, they require liquidity. And such liquidity is brought about after a long time of consolidation. And this is seen on higher time frame, specifically the daily time frame. Now, before any major move, we experience the loss of liquidity. We can say the market will not be volatile. This is the time when the market is consolidating. And when the market consolidates, then market makers usually allow orders to build on both sides of the range. And before he expands to the true trend, market makers will show a fake mover, and that fake move will be the opposite of the majority. And here he will take out traders. Also, he would induce traders to take wrong position. And once they are trapped, you'll see a start of the real seasonal trend, which is the profit expansion phase. Now, why should we know about this, about the seasonal changes? Because there is a high probability of seeing big market shifts after every 3 months, after every quarter. So we need to monitor the market during this period of time and include COT and index analysis for confidence. So you look at COT reports and see where the open interest is at and where the large speculators are. But also you need to do the analysis for index from the indices. So you need to see where the dollar is about to go, or where the euros are about to go, or the pounds. Usually this shift, when it occurs to pounds, you see a 2-month move in that direction. Or when it occurs to maybe to euros. Also, you see a 2-month move towards that direction. So you need to be in that phase. So you have to include the index analysis for complex. And without understanding the seasonal move, you are prone to trade within areas of consolidation. And within these areas, there is a high probability of getting a loss because market maker trend is usually not followed in the hour and time frame.
Okay, sorry. What is COT?
Commitment of traders. We will learn about COT tomorrow.
Okay.
So you won't be able to see levels in the hour, especially the safety trade. You see, they'll give you a pattern and they will break and hit your stop. And you see, when you enter in the market, when you open your MT4, you are eager to enter your trades. So market makers will test your passions and that need to trade within seasonal consolidation. And well, when you enter the market, when you enter a trade within this consolidation, usually the false move before the real trend will take you out. That's what happens, because you will be seeing a buy. Yes, eventually the market will buy, but they will start by selling first, hit the stops, and then they will buy. So we have an example of USD. We have here is where the dealer set the low of the year, and here is where the dealer set the high of the year. So we have the low of the year and the high of the year. The first quarter ended here, and the second, see the third is here, and here we have the fourth quarter.
So this is last year?
Yeah, this was last year.
Okay.
So quarter one, it was all an uptrend, yeah?
Yeah.
And quarter two, we had bearish and bullish market. So if we had a candle for the quarter, this will be a doji. And on the third quarter, we had an uptrend, a very good uptrend. And there is where the dealer did set the high. See, from this low of the year to this move here, this was all an uptrend. And from this, after setting the high, we had a downtrend. Now, see, from setting the low of the year, we see clear 3 levels going up, like the first, the second, and the third. These levels are a bit rough, huh?
Yeah.
And here the dealer did set this, and this was actually a return to this order block here. But then we had a 200 bounce here. Usually the 200 EMA, when price bounces around 200 EMA, it's a very good sign of a reversal. But then this was a W here. And we had clear 3 levels going up. And here we had a head and shoulder pattern. And we had highs here where the dealer did take them out, and it did take this this high that he has formed here. So the dealer grabbed the liquidity needs. Eventually we had the head and shoulder and a reversal there. And here we had a level, and the third level. And this is what we call the consolidation.
Yeah.
And then we had a shift. And he was finding external liquidity up here. This is an area of liquidity pool. And this was the high for 2018. So the high for 2018 was also here. So this was a stopper towards the high. Now you can see how the market is was rising here. This was the first reset, and if this was the cycle, that means the second cycle may be it ended here. So we had quick resets going up. Bounces around the 5 EMA, which is the same as the 50 on the 1 hour chart. And then eventually the dealer ended the shift there. And you can see where when the dealer reached this high of last year, this was an area of resistance. So almost all traders are looking to sell here. So it'll give you a sell opportunity come to take you out, sell opportunity come to take you out until he has the liquidity. And they'll force people to believe that he's still going up. Because around here we had also this area here where he was retracing and going up. So he was forcing people to believe that he's still going up. And there, after having the liquidity, we had this shift. This was a return to the order block, and then we had a shift there. So points to note when you are analyzing this, the daily time frame, because this is simple repetition of the daily time frame. You see this move here. From this shift, we had the first month, the second, and third month. We had 1 month of consolidation from this W, and we had 1, 2, 3 months, and this was the fourth. So you have to be in these shifts. See this consolidation here. This is what I was saying. And this was Euro JPY. We had a very good consolidation here. And then we had a shift. This was 1 consolidation to 3 months. So this move was around 3 months. And then we had this pullback, this W here. And then we had the first month, and the second we had the consolidation, the third. So once you see a shift, you see several peak resets on the hour time frame, but you need to be monitoring this daily time frame to see these pullbacks and all that. So from the graphs, we have observed the consolidation phase where dealer accumulates before having a shift. At times like this, tokens will be both ways. The cycle in our time frame is not followed. ADR is reduced to minimum. Usually there is a loss of volatility and ADR is reduced to minimum. Around this is where you find ADR times 1 for Euro USD is around 44. But right now ADR is around it's around 102. So you see the ADR has decreased to 44 pips. Now, the period setup is usually followed in the 15 minutes, but you'll not be able to trade the period setup well if the cycle is not followed. And stoppers are deep when the dealer reaches lows of previous month or year, or when the dealer reaches the highs. Usually stoppers are deep. And we have observed the shift now. Before shifting, the dealer usually offers a false move, 1 week false move usually, and then you see a shift. News is used to perpetuate the move. And after the shift, you see 3 good levels, and this would indicate several peak recesses on the hour, and at least 2. And always trade in line with this trend. So if you're doing your analysis on the hour, I should be in line with this shift. And at this time, you only see weak stop answer as the dealer moves from one level to the next. ADR value will increase to the maximum. So this is the time when you see ADR going to the maximum. And you need to be careful with the EMAs. 5 and 13 crossover indicates a start of a shift. And pin to the 13 EMA after the price has moved. When you see 5 and 13 crossover, price has moved and then it has retraced to the 13 EMA, and you see a reversal there, then that's a peak reset on the hour. Also, a pin to the 5 EMA usually is a continuation of a trend. Normally, you see a peak extension or a quick reset. And a pullback to the 50 EMA is usually a safety trade on the daily, which is the same as on the hour, and will be around 800 EMA, so it's an EMA peak. And pin to the 13 and 50, these are solid peak reset areas. So when you see the dealer is pinning 13 and 50, that means on the hour is around 200 and 800 EMA. And we have the 200 bounce. When the dealer bounces around 200 EMA on the daily time frame, usually price reverse, even the 800 or the 3,200 EMA. And when you see that price is near the CMAs and maybe an hour and the cycle is complete, you should expect for extension to these levels to touch the CMAs and then reverse. So I need to be careful when there is this shift, okay? And that will be the end of the seasonal moves.